All right, I call the meeting to order.
Okay, roll call. Mr. Covey,
Here.
Miss Elliott William, Mark Gardner,
Here.
Joel Hawkins, David Holly,
Here.
Landon Moore,
Here.
Addie Phillips, Karen Savage.
Here.
We have a quorum, that's good. Derek Challenger,
Here.
Kathy Crocker,
Here.
Gregory Coleman, and by the way, Gregory is the recently appointed Human Resources Director for the city.
Good morning. Morning. Morning.
Stacy Porter, who just left the room. There's Stacy Porter here. Stacy is going to be providing a lot of support to this board moving forward. Zaire Boone.
Here.
And Gloria Taylor.
Here.
Gloria is the recently appointed interim CFO for the city. Okay, we have a quorum.
All right, the first item is approval of the minutes from the November 10th meeting, and also there was we need to
August 11th meeting, yeah.
approve August 11th because there was not a quorum at the last meeting. Does anyone have any comments, questions, edits?
I make a motion that we approve both sets of minutes as written.
I'll second that motion.
Everybody in approval? Say aye.
Aye.
All right, minutes are approved. The next item is board elections. We need to elect a new vice chair. Mr. Holly is stepping down, and also elect a new chair. I'm willing to stay on, if so approved by the board. First, we can do vice chair. I nominate Mark Gardner.
I'll second your nomination.
Everyone that approves, say aye.
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 Aye. All right, congrats.
Congratulations.
Next, the chair. Have any nominations?
I nominate Landon.
I also second that nomination.
All right, all in approval?
Aye.
All right, that is that's done. Next item.
Yeah, the meeting days and time. There was a discussion about the possibility of moving the meeting day and possibly the meeting time of this body. I did do a canvass the group, and there was no one that I could find who was, there were several people who were flexible and that they could go either way, but most people were happy with the current arrangement. And so my suggestion is we do not change it because there was not, didn't seem to be support for it. And it impacted somebody negatively regardless of what we did. I did want to just ask one more time of this group, is 8:30 in the morning satisfactory time, or is there any, I know a lot of you all have jobs to go to, so 8:30 is preferable, but I did want to at least ask whether a 9 o'clock works for some people. A few people have obligations earlier, so just wanted to make sure we cover that before we close that issue. So hearing none,
I'm good with it.
I think we will, we don't need to do anything then. We're just going to leave things the way they are.
Okay. Next is the OPEB trust.
OPEB trust, let's see. In your package, we've got the current balance as of January 24th market value was $6 million. You get in the package, $6 million. It's looks like this. It's got a little target right here. $6,765,887. The original cost was $5,478,407. The city has not made its contribution this fiscal year, but I talked to finance, and they will be making that contribution, probably making it as we speak. It's either $1 million, it's $1 million, at least $1 million going into the OPEB trust. I knew that would be a question. You can look in your attached to your agenda, there's a more detail, more than what I've printed. But you'll see we've got the portfolio review in here, and then also through December, sort of the boilerplate detail. But as you know, the Portsmouth is in Portfolio 1 with the VML VACO pooled trust. Any questions? We can try to get some more information if you need it. But it's doing well, and the city is committed to continuing its contributions.
Anyone have any comments, concerns with the OPEB trust? Okay. Next item is the portfolio review by Greystone. We have, as usual, Brian Birnbaum and James Whitney
Yeah,
here to present.
there was a confusion in that their books that they prepared for us were not delivered. And Zaire is trying to pull up the, how are you doing, Zaire? We're going to get it on the screen.
Yeah, the computer's kind of glitchy, but it's working. Just give me just a few seconds.
Should we do the closed session while we're waiting?
That's a great idea. Do you know what you need to read?
Yep.
Okay.
I move to go into closed meetings as allowed by Virginia Code 2.2-3711 and 2.2-3712A pursuant to the applicable exemptions, Virginia Code subsection 2.2-3711A8, for the purpose of consultation with legal counsel employed by a public body regarding specific legal matters requiring the provision of legal advice by such counsel, and pursuant to Virginia Code subsection 2.2-3705.11 and 2.2-3711A1 for discussion of personal records containing information concerning identifiable individuals as it relates to eligibility for retirement benefits.
We'll just close it for a minute.
I didn't catch all those sections.
That was a mouthful.
Okay.
Do I have a second?
Second.
And all in favor?
Aye.
Aye. I hereby move that each member certify that to the best of his or her knowledge, one, only public business matters lawfully exempted from open meeting requirements under the Virginia Freedom of Information Act, and two, only such public business matters as were identified in the motion by which the closed meeting was convened were heard, discussed, or considered in the closed meeting just concluded. All right, I motion to vote on adding the spouse to the participant just discussed in the closed meeting.
Second.
All in favor?
Aye.
Aye. Okay, approved. Now we can move on to Mr. Birnbaum and Mr. Whitney.
You got those lines. Yeah.
It looks like the electronics got caught up. timely.
I've been asked to get the paper and we don't have it. I know, I was like, I told that.
Stacy, good luck now.
Something right there. Which one do you want? This one. Five, yeah. This one. It's all right. Save some paper.
Yeah, then we might want to do this also.
Oh, this is the.
The November, that's the last meeting.
I was driving in and the police chief called me this morning before I left. And so he was
That's
like,
last quarters.
driving down the street.
That's not gonna work.
But go to the calendar.
We're gonna cut this part from the video.
You know, that while we're waiting, I've worked as an officer dealing with criminal law every day, but your side of the house is so different.
Way different. And I only do
But I had pictures, but I didn't see it.
But your
And I
stuff
said,
is
well,
deep
what are
too,
they doing? He said,
in my opinion. It's very deep.
the homicide
what
this
it
week.
was
They
because
found out it's
so many nerves on people.
man and woman did it.
Yeah, I mean,
They were waiting for the child to get on the bus. But they went into the house.
Oh, land use
And to see it,
and setting the
was just, I was
precedence
like,
and then
oh,
sometimes
wow.
ends up in the judge's
And
lap.
everybody's kind of hanging back. You can't hang back and not be seen.
I
know you did.
Same
Mine
early.
did.
Right.
It is on
Yeah.
my calendar. It's just some
people leave and
Oh, yeah. Well, the area of Child Protective Service and all that, I was very close to that for 7 years. And that's something too,
Let me go and
you've got
send
to
it
be
to you.
well-versed on representing.
yeah, very much so. And I don't know very much about that area.
No, it's not you. It's just
Sheila Riddick and all
Yeah,
this
oh,
stuff.
Sheila works for you. Nancy,
It is Q3 that's attached to the meeting invite.
I took her place.
okay.
I mean, to the.
Nancy was well-versed. Sheila is too. I work with Sheila.
Yeah, Sheila been there for 38 years.
While we're waiting,
Worked as an investigator.
Should we,
go over this?
For seven-
Could we let
7
John
years.
Hancock go first?
Yeah.
That's fine.
You're ready?
I can be ready.
Well, his attachments wasn't there either.
Yeah, well, one of them is, I mean, we can just talk quickly about the funded status reconciliation if you'd like. So that is,
That's what I want, yeah.
that is in the folders in a printout. So as we've done in past meetings, you'll see this attachment here is structured so that page 1 shows the ongoing change for the fire and police system. Page 2 shows the ongoing change for the supplemental system. And then if we go to the third page, you can see a combination of both systems. So the first block just looks at, then this is based on fiscal year. The first block just looks back to June or to July 1, 2020 through the end of June of 2022. And now we look at the next section and primarily the bottom grid, which looks at the activity of the second quarter of the current fiscal year. You'll see that market value of assets did increase. I just want to point out, you're going to see typically on all of our reporting and Greystone Morgan Stanley's reporting, you're going to see market value of assets match up. There are going to be at times slight variations in this report. It is due to some of the ongoing reconciliation of the majority of the portfolio being held at Morgan Stanley. So it takes some time for evaluation that stretches past typically when this is done. But what I can say is during the quarter, and I know Brian and Jim will talk more about what impacted the positive performance of the portfolio, but portfolio market value did go up. We're reporting here a little over $184 million. I think you'll see in some of the other reports it's around 182 million. But the good news is there was a slight increase in market performance due to market performance, and then liabilities did shift down slightly. That's just an ongoing change based on the population changing within the program. So all of that resulted in a slight increase in the projected funded status of the combined system of being 64.59%, closing out December. One other item I'll point out here is you'll see that there are no contributions shown in the last 2 quarters. We did just, I think it was last week, it was on the 2nd, we received a contribution for the city for the entire fiscal year of $7.8 million. So that was just invested last week and allocated appropriately amongst the 2 systems. So you'll see that impact at our next meeting when we close out this quarter.
Remind me when you do that calculation of the contribution that you sort of recommend.
Yeah, so that's formally done once the fiscal year ends and part of the annual valuation. We report out on it typically around the October time period.
So that was based on sort of the funded status of the plan back in June.
Correct.
22.
Yeah,
Like if you did that today, it would be slightly higher.
Yeah, there would be an adjustment.
But it's based on the actuarial value, not these values. It was on the actuarial value they determined the contribution.
The smooth asset value.
Yes.
Correct.
Yeah.
Yeah.
So even though the
Wouldn't make much
portfolio's loss of value wouldn't be as dramatic from the standpoint of the actuarial calculation.
Right.
Speaking of actuarial references, I believe I shared this at least with part of the group, but Andre Stewart, who's been the managing actuary on the system for the majority of the time that you all have been with us, he did leave our firm in November or early December. There's a new managing actuary that's been assigned. His name is John Morrison. I've had a few meetings with him already. He's met internally with others within the group. The internal staff that works on the retirement system is still intact, so they've been able to share information to him as well, and he's coming up to speed. But he will, at a minimum, he'll be out here in the fall to provide the valuation review at that point, and we're happy to set up a call or something if we need to have a conversation with him prior to that.
I may be getting ahead because it's something that Greystone can speak to too, but I'll ask from your sort of perspective, have municipalities been raising their expected return? I know, capital market assumptions, forward-looking are sort of point in time, and when you look at it from where the markets are now, or the forward-looking returns, from what I've seen have gone up, and have municipalities been changing that, and how big an impact is the only impact to that for a city, the calculation of the required contribution?
Well, I think there's the discount rate consideration too, and if there's going to be a continuation of the level of where that's at. I know that's something that John, coming in, had started asking about and wanted just to understand a little bit of the history there, just based on current environment as well. With regards to performance, I'll probably leave that to Jim and Brian, but at this point I haven't seen any immediate change or reaction to it. I think it's still kind of a wait and see to see how things develop here with the changing rate environment. Obviously that's slowed down a little bit, and I think the thought is that may settle in here over the next 6 months or so. But
we had never, since I can recall, I don't think we've taken it down any.
It was prior to your time. It goes back quite a bit, but there was one reduction made years ago, I think from 7.5
to 7.25.
to 7.25. Yeah. And I know the last time, I don't want to speak for Brian, but I know Brian had shared some research just taking a look at municipalities and the VRS. And I think at that point, The VRS might have had a slightly higher rate at that point, but 7.25 seemed to be within range.
Although right now VRS has got a lower discount rate.
It's lowered now? Okay.
Yes, it's, I'm trying to think, is it 6 3/4?
Yeah, Landon, I would say the clear trend on expected return assumptions has been downward. There's nobody that's adjusted theirs up yet, even in light of the fact we've got higher interest rates and higher inflation. And the issue with the assumed return is it just kind of tells you when you're going to contribute cash, right? The lower your return expectation, the sooner cash contributions go up, and then the higher, the more spread out it becomes.
But it would also, I guess, from, just the city's balance sheet perspective, it's going to show less sort of pension debt.
We sent the wrong one.
Yeah, and I know Andre had provided, I don't have it up in front of me, but he had provided out that projection.
I'm not
Yeah.
suggesting that we change it. I'm just sort of asking, what have you seen, at this point?
Yeah, I think, John's not here, but I think at first he questioned the 7.25 and whether or not there'd been discussion to lower the discount rate. So that may be something that there could be discussion about, but again, that's going to have obviously an impact on contribution going forward. I think it's still where it is right now. There should be comfort with it.
So, like, from my perspective, I think the discount rate's high and the expected return's a little low. So maybe it's a wash.
Yeah, so.
They're the same.
I know, but like,
But he's just saying from his what he think they would be, where they should be.
I know for the city, I mean, the rule is they're the same.
Yeah.
I think the discount rate's too high and
Yeah,
the
in the
expected
corporate world,
return's
they're
too
very
low. I
different.
don't know if it's a
Yeah.
wash or not.
Yep.
All right.
I'm sorry, we emailed third quarter report.
Tom, do we expect the actuarial study then to be presented to the board, say in a future meeting in the fall?
Yeah, annually we do it in the fall.
Okay.
Absolutely.
You might remember, we covered it, I believe,
The
last meeting.
The November meeting, yeah. Andre came down, and typically that's, in the past at times we had done it in October as kind of a separate meeting or readjusting the meeting, but I think over the last couple of years we had just adjusted to stay on schedule.
Yeah, the
Just
staff
do it
has
after you meet with council.
No, we use it to report for the liability side on the city's financial statements,
Yeah.
all this stuff.
Right.
And we use it to help us budget.
Right.
Yeah, and we typically provide information a little earlier to the city.
Yeah, and so we brought it to the board, but the 7.8 million that Tom said that the city had sent is exactly what
What they
the annual
recommend.
required contribution calculation was based on the most recent actuarial study.
Right.
And if we lower the discount rate, then that annual required contribution
Increase.
will go up.
Right.
Your, remind me what the rate is on those pension obligation bonds. I bet you like the rate on those these days.
Yeah, because they had been refunded at the appropriate times, on the remaining debt, it's something like 2.4%.
Yeah, it's almost like free money. when you look at it.
Almost, yeah. But they were issued at a time of low interest rate, and then when the interest rates went down further, they were refinanced.
That was that in 21? That was good timing.
Yeah, some of it was. yeah.
Davenport recommended that, I guess.
Yeah, well, we did a lot of refunding around then. Not only on those, but all of the city's debt that we could refi.
You locked in a lot of stuff at fixed rates.
Yes.
The only, I give just a couple of other updates. Obviously, the information isn't up front, but the activity from a benefits perspective or change in the population through the last quarter was very minimal. In fact, and I know the question just came up as to total accounts. Currently, there's 1,016 total accounts within the combined system. That includes actives, individuals receiving benefits, and those who are terminated but vested. There are only 3 actives left in the fire and police system. All 3 of those individuals are over the age of 50, and all 3 have 25 plus years of active service, so you would expect those individuals to be retiring soon. And then 625 of the total 668 are already receiving benefits. So there aren't many that are not receiving benefits that are left in the system. And then for fire and police throughout the fourth quarter, the benefits only ended for 1 individual. Unfortunately, due to the death of that individual, there were a few other deaths, but those transferred over to spouses for continued payment. And then in the supplemental system, there are only 10 individuals left that are active, and there are only 10 individuals who are terminated not receiving benefits. 328 are receiving benefits. So again, vast majority are receiving benefits. 9 of the 10 active individuals are over the age of 60, and all have at least 25 years of service with the city. So, again, as we've talked about through the years, the system is getting close to being fully closed. And there were 2 incidents of benefits ending for the supplemental system last quarter.
From death?
Yes.
And that's all taken into account when you do the annual required actuarial study.
Correct.
Tom, do you know what the average age is of the participants in each one of the systems?
I don't. I believe, Mark, you may have asked me that before, and I think we looked at that. I will look for it while I'm here. If not, I'll...
That's usually part of the actuarial study,
Right.
so it's not necessary to get that. I'm just curious.
Mark, if you go to the November meeting agenda, attached to it should be the actuarial study. If you want to take a look at it.
And I guess the last thing I can add is just from an overall expense of the system. Again, we report on this on a quarterly basis as well. If you look all in at the overall expense, and this includes investment management fees, it includes John Hancock fees, and it includes Greystone's investment consulting fees, the systems are right around 51.6 basis points, roughly. That's been fairly consistent over the past year plus. I know investment management has ticked down slightly, but just as a reminder, the vast majority of the assets are held at Morgan Stanley in their actively managed account. I know Brian and Jim and their team continue to look for savings opportunities. So.
How are we doing over there?
We're moments away.
Okay, all right, just checking.
So in the fire police, any active members are on the fire department side? No active on the police department?
Okay. But you were one of the 3 actives on the system, so.
Yes.
He just retired, so that number's going to go down.
Oh, congratulations.
Thank you.
Oh, so the 3 that are in F&P are just fire, not
Yes.
police?
No police, as I'm aware of, or
Oh, so you were the
So just
last.
fire, no
I was the
police?
last one.
Currently, the 2 policemen retired January 31st, and so there's only 1 fire person actively left.
Okay. There we go.
So did you count him?
Fire, no police.
So yes.
Say it like that.
So it's, well, it makes sense.
There we go.
It's marching on.
We're all just trying to make
The last thing I'll mention, I did include a slide in here. It's actually tough to see anyways if you can see it, but we do include, if there's ever an opportunity, I'm kind of looking beyond you, Landon, but we do include in our services that we can provide meetings for retirees. If I know in the past, it's been a few years, but we have done some of that in the past. But if there is ever interest in that, again, most of the system is closed. But for those individuals, if there are some in the area that still haven't made a decision, if there's ever a need or an opportunity for us to kind of come down and talk about options, we're happy to do that. So.
Thank you. Brian's going to be presenting from the back of the room, controlling the deck.
Sorry about that. After 3 years, you'd think we'd have technology figured out, but
Well,
apparently not.
would you like me to sit there and you?
No, because there's we're not going to
change
go in
these.
order.
Okay.
I got it. That's okay.
Okay.
Thank you.
Okay, great. Well, now that that's behind us, it's wonderful to be with you all.
Good morning.
Glad we have material. It's so hard to present without the material, so I'm glad we have the material. I would just like to start with a little color on bullet point 5 of the board agenda, because I know there was an ask to consider changing schedules. And the reason that it is on your agenda is that both Brian and I make 3 trips about this time of year in a row, 3 weeks in a row to the area. We're fortunate enough to work with 3 clients, of course, important being Portsmouth today. So it was an effort to reduce our carbon footprint. We enjoy the face-to-face meetings, but if we could somehow sync those up, it would be much better for the environment. But in no means did we want to inconvenience the board. So if there's an opportunity in the future, just let us know. I think it was clear you're going to status quo from the request, but we thought we needed a little bit of context about what was behind that request. It wasn't just a random, let's change the meeting. So
I did not know that this was on the agenda because of your request. I thought it was because of a board member requested the dates and times.
Yeah, that's why I wanted to
it was both.
I wanted to give a little bit of
When I
context
passed
around it.
over that, I was
Yeah.
looking over there, and y'all were like, "Well, they didn't talk about us." You know, I totally defer to the rest of the board, but from my standpoint, I'd be okay to either, keeping the 8:30 time, but either adjusting to the, I think with the third week of the month, to switch it to the second week of the month, so to align with their other board meetings.
I think they were asking for the first.
We'd slide it up 1 week.
Slide it up we're the second Thursday.
Slide it back.
Move to the first Thursday.
Yeah.
I'd be okay with that. I would also be open to, having them only come down in person twice a year and do video twice a year. But totally open to
Yeah.
what.
To reduce the travel, you could stay and fill some interim positions. So we have the track record speaks for itself.
That is true. I was going to offer the same thing, that once or twice a year we could do this. You all can present. We have to be here in person,
yep.
but you don't.
And even like it could work that for John Hancock too. John Hancock's here 2 times a year in person, and the other 2 meetings, Greystone's here in person. They flip that.
That's a good solution as well.
So did I understand you have to be in the area quarterly the first week of each of those months for meeting with other clients in the area? So you would be here if we moved it forward by a week?
Yes.
Okay.
That's right.
Good too.
All right.
It just feels bad, the carbon footprint coming here 3 consecutive weeks, all within, pretty close proximity. But the last thing we want to do is inconvenience the board. So we'll continue to operate at the pleasure of the board in any capacity you wish, but I would just want to provide you a little context around that.
So we would. I think we have to vote on changing the meeting date and time, but we wouldn't have to vote if we just say, the whole, you only have to be in here in person twice a year.
Right. Yeah, for them, that's just, a detail. Yeah, we don't have to vote if you
Right.
just work it out of how you want to do that.
Yeah, and if it's okay with you, maybe we try that.
Yeah.
And if it's not working for whatever reason, we're happy
Look at
to
something
do that.
else, yeah.
Yeah.
I mean, so I got the sense that people like the early time to stick with 8:30, but does the first week of the month versus the second week of the month mean anything to anybody?
Doesn't make a difference.
I'm flexible.
Now that you're retired?
Right.
My schedule's wide open now. Would you be okay with that?
Sure, it don't make a difference.
Okay, well, should we vote? To move it to the first Thursday of the month?
Well, I know that John Hancock had a problem with the first Thursday.
No, so I personally will not be able to be here for the valuation review, but I'm sure John can do it. So it should be fine. I think before, correct me if I'm wrong, we may have been looking at the first and third weeks. I think the third week might have presented a little bit more of a challenge for me, but first Thursday is not an issue.
Okay, very good.
And that still gives both of you enough time to complete your reports and
Get
things?
the data together. Yep, shouldn't be a problem. There might be one or two pieces of stale data, but it's not going to alter the discussion in any way.
Still quarterly.
Right.
Yep.
It'll be still February, May, August, and November. It'll just be the first Thursday.
And as far as staff, does that conflict with any other
Yeah,
board meetings or
the only-
anything?
That is
The only thing I
never,
need, well, I can do that.
that's not an issue. We'll figure it out.
Okay.
Okay, I make a motion to change the meeting times to the first Thursday of the month.
I'll second your motion.
Approved.
All in favor?
Aye.
Aye. All right.
Greystone Consulting and the environment thanks you.
You won't have quite as much frequent flyer miles now.
That's right.
We will also point out that the technology that's available here at Portsmouth as it relates to some of our other clients is really terrific.
Oh, my.
Absent,
Except for what now?
we weren't planning on it. FedEx was supposed to deliver the meeting books on time, but that didn't happen. But in terms of Zoom capabilities and acoustics and audio, it's really good, really quite good.
You go back and watch the videos
YouTube
online?
playback.
All weekend long.
You're like, I'm going to look at cities that we don't even cover just because I like it so much.
All right, so thank you for all that. We really do appreciate it in all sincerity. I'm going to, Brian, you got this slide up? Yep. So this is I'll come back to this in a minute. This is asset class performance by decade and by year. I'm going to draw your attention to 2022 in just a minute. Performance and comment on the disparate performance and some unusual characteristics of capital markets. But before I do that, I want to provide a little bit of narrative to close out 2022. Last year was an unusual year, and then I also want to give you a little bit of color as to how we're thinking about 2023. So as it relates to 2022, we're glad it's over because it delivered a very unusual dual bear market in both stocks and bonds. And that rarely happens. Investors allocate money to equities. They expect and know that episodically it will decline by 20%. It just comes with investing in equities over time. But on the fixed income side, that's a very rare situation. And I think at the worst, S&P was probably down 25. We're going to go through the numbers, down 20-ish%, along with other equity markets around the world. But the bond portion, which normally holds up in periods of adversity, just didn't hold up. And that's very rare. We've got to go back decades for that experience. So for our clients, it felt like a very difficult market environment because it was. It was a really, really tough year. And you think about equities being down 20-ish%. The 20-year U.S. Treasury, if you just, that 20-year U.S. Treasury bond was down 31% last year. Just to put that fixed income market in perspective. So what we saw last year really was a textbook dynamic response. Nothing terribly unusual from our perspective. We saw excess stimulation coming from both the government and from the Federal Reserve. And the Fed maintained this transitory inflation narrative for most of 2021, and then embarked on a very aggressive tightening campaign. Ultimately, they raised interest rates from 0 to 4.5, 4.75%, which is where we're at today, and probably on its way to 5, perhaps 5.25 when we look at the forward meetings on the calendar for this year. So when you think about going from 0 to 4.75% in such a short time period, like we haven't seen since the 1980s, that's a tremendous amount of pressure weighing down financial market. It's an awful lot to digest for a few reasons, which I'll touch upon in a minute. So I guess the good news from our perspective is that nothing catastrophic happened. You know, the credit markets didn't seize up. The capital markets, generally, equity markets continue to function. People generally just went about their business. Now, there were some areas that got hurt, and they tend to be a little bit more speculative. So if you follow SPACs, they were destroyed. High growth stocks got hurt. Cryptocurrency got hurt. So very speculative parts of the market were damaged, understandably, in a rising rate environment. The housing market was also had a bullseye on its back from the position of the Federal Reserve. And why is that? It's because of that multiplier effect. Housing prices felt like a little bit of a bubble was getting created, money was free, and then there's the multiplier effect. So somebody buys a house, and what do? They home improvements, durable goods, new refrigerator, new appliances, and all of that creates additional pressure on inflation. So mortgage rates doubled to 7%. They've come in a little bit since, and that was a 20-year high in mortgage rates. And what happened? You know, we saw a 17% decline in existing home sales, and we had a record 11 months of consecutive decline. That's never happened. So the Fed's work is really starting to filter into the real economy. This year, things are looking a little bit better, and I'll go through some of these slides in just a minute with you. So we're starting to see on the producer inflation side, starting to see that roll over a little bit. Consumer price inflation starting to roll over a little bit. Wage inflation, which is something the Fed is very concerned about, starting to soften just a little bit. I can't say that it's rolling over just yet. And then we had the reopening of China, and then we had tax loss selling pressure from last year from retail investors subside as we rolled into the new year. So all of that has really resulted in a pretty good start to the year here in January. And Brian's going to update you all on that in just a few minutes. So pretty bullish narrative to start the year. And you know, we had a really incredible January employment number last week. We had 517,000 new jobs, which was 3x what everybody was expecting. And unemployment now is at 3.4%, which is the lowest it's been since 1969. Which is wonderful for the economy, but it just tells you how resilient it is and how hard it is for the Fed to slow down growth and get inflation back to the 2% target. So probably end up having rates higher for longer as a result of that. So the way we think about the impact on both the bond side of the portfolio and the equity side of the portfolio is really in chapters or phases. And so with the bond market, you know, the first phase or first chapter is very simply Fed raises interest rates go up, bond prices go down. It's just math. And the longer the maturity or duration on the bond side, the more the prices are going to decline. There can be a second phase, which is really credit deterioration or credit defaults. That's really not applicable today, but so phase one is complete, and that was the most painful part of the bond market last year. And our view is that those rates, they may fluctuate a little bit, but we're past those peak in rates as the Fed ends its tightening campaign, and we really like the bond side of the portfolio for 2023. We think it'll be a strong performing asset class, unlike last year, as the Fed dissipates its tightening campaign. On the equity side, there are two distinct phases. One is when interest rates go up, there is an effect on equities as well. I think the easiest way to think about that is if investors are looking at buying a growth stock that is selling at 60 times earnings, very fast top line growth with low levels of profitability, and interest rates went up to 4.75%, investors are going to say, look, I'm not going to pay 60 times earnings anymore because I can get 4.5% of my cash. So that discount rate goes up, and then that multiple that investors are paying on stocks in general or growth stocks in particular, it comes in, and those stocks get hurt pretty badly. So that phase, because in our view interest rates have generally peaked, is behind us. The second phase is the earnings phase. So a very aggressive Fed tightening campaign. There's typically, if we look at history, there's a 9 to 12 month lag between the Fed tightening policy and the impact on the real economy as it trickles through. Housing market's a good example. And that's just starting to happen. So phase two is an earnings reset as the lag effect starts to affect the real economy. So we look at earnings here in the first quarter. We think they're elevated. We entered 2023 with positive earnings expectations for the S&P for the year. Those earnings estimates have just gone negative. And what history tells us is when they go negative, and that happened in 2001, 2008, 2015, and 2020, the last time that happened. And in each of those times when it went negative, the magnitude of the price declines in equities happens at the time it goes negative. So those earnings estimates had not been fully discounted at the time. The order of magnitude of the decline is at the point where they go negative. So that's where we think we are in the cycle. We think we'll get through this second phase, the reset phase here, probably in the first quarter. And we have a couple charts I'll walk you through, but that to us means we could see, at the lows, we could see the market down maybe another 10 or 15%, depending upon how sharp the earnings deceleration is. So that's sort of our view on equities. We think we move out of this earnings reset as we go through the course of the year, because somewhere towards the middle, the back half of this year, investors are going to be focusing on 2024. And those earnings look better to us, rates look stable, the Fed's tightening policy might become a Fed easing policy, capital markets should do better. And as allocators of your capital, Brian and I are not terribly excited about timing these short-term events, because it's really hard. And if you compare our advice to other major consulting firms, I mean, we were absolutely spot on in terms of what we were thinking about equities, and you'll see that is reflected in our equity allocation of the portfolio. So our hope is we're right here at the earnings reset, get the capital deployed, get back to our equity targets, which is ultimately where we want to be. So those are my thoughts on the markets and the economy. I'm going to go back to a meeting book that you don't have, so slide 5. So what you're seeing here is, make it easier to point here. So I'm looking at 2022, and you see at the top, we've got an eclectic group of asset classes that did really well. Master limited partnerships up 30%. Underneath that is managed futures, commodities up 13. So these are not typically asset classes that you're going to find in meaningful weightings in most client portfolios that did well. If we look at the center here, we see U.S. debt down 13%. Developed market international debt down 18, emerging market debt down 17. So the fixed income side, as I was saying earlier, just absolutely provided no relief in a bear market. Next slide, Brian. So here we want to look at a little bit deeper dive than just looking at a equity index. So we're going to look at factors. What factors were really driving performance, negative performance last year? And so we're looking at the top left. This is the U.S. index. So this is the Russell 1000 growth, down 29%. Value, just the opposite of what investors are looking for. Fast-growing companies, much lower price sales, much lower price to book, down 7. But even quality, which is something that permeates most of our managers, we believe over time that's going to make a difference investing in quality managers. Quality really didn't help either. It was down almost 23%. And this is for the U.S. If we look at non-U.S. International indices, pretty much the same story. Growth down 22, value is down 5 or 6. Quality, again, didn't help you. And then in emerging markets, really the same story, down 23 versus 15 for value, down 22 for growth. This next slide, I'll just draw your attention to the left side. This is what I was saying earlier about the failure of fixed income in the portfolio. So we have 9 different fixed income categories here. 10-year U.S. Treasury down almost 15%. Widely held, one of the most liquid securities in the world, is down 15%. Excellent. So here I was alluding to this in my comments. So here we're looking at, this is the Bloomberg, so commodity index rolling over. This is all against the CPI year over year. So you can see inflation starting to roll over here. The US dollar starting to roll over as the peak in interest rate cycle is upon us. Personal income versus CPI rolling over. And this is probably one of my favorite, money supply, M2 versus inflation. You can see utter collapse in M2. We really haven't seen this type of decline in a very, very long time. And you know, there's this old saying that inflation is everywhere all the time, and it's driven by monetary policy. So this is one of the slides I get great comfort in, that the Fed will get control over inflation over time. Is this complete collapse in the money supply.
I heard from some other bankers that deposits have declined dramatically. As you get, I can't remember, does Morgan Stanley doesn't really have a retail bank? So you don't probably don't have a sense of that.
We don't, but we see the data, and it is a concern for banks because they're offering 5-6 basis points on cash at the retail level, and then they're of course lending that out for a very significant spread, and rightfully the cash that consumers have in banks, it's exiting for much higher rates that are available. Even in a T-bill, you're going to get 4.5%, 4.6%.
Yeah, CDs.
CDs are. That's the one bright side of the Fed tightening, is we haven't had these returns on cash that consumers are starting to experience now in a very long time.
I had heard that the people are saving more. Is that reflected here or not? Or is that a product of this?
That is absolutely not the case.
Okay.
It's a perfect segue to this slide. So we estimate that about 2.5 trillion of stimulus that's been provided has already worked its way through the system. And what we're looking at here is outstanding revolving credit card balances. And now it's above where it was pre-pandemic. So consumer debt is very high, record high. And this is the consumer savings rate.
Okay.
And it's at the lowest level in 15 years.
Okay, savings rate as opposed to, I'm just making sure I understand, accumulated savings, is that two different things?
Well, we're looking at personal savings as a percentage of disposable income here. So it's slightly different than what you're asking.
Okay.
But directionally, the conclusion is the same.
And we've seen the same from 401k savings rates as well, definitely decline where they were up during the beginning of the pandemic. So there's less discretionary spend, but it's following along, not as significant, but.
Yeah, I feel like we were just talking not too long ago about consumer sort of balance sheets were in great shape.
Yeah,
Not that long ago, right?
yeah, because the price of lumber had gone up.
You remember, you were
Yeah,
paying attention.
I do remember.
Now it's eggs.
Yeah,
eggs.
$500,000 for eggs.
Take out a loan to get an egg.
Nobody should have high cholesterol.
So just go back to the slide just to amplify this. So this is the lowest savings rate as a percentage of disposable income in 17 years.
Wow.
So, and it's only happened once, and that was in 2005, just before the great housing crisis hit.
So where's the money going?
It went into the real economy. It's what created the supply chain disruptions. And now it's being channeled into leisure and travel.
In other words, people are spending it.
They're spending it. Yep.
I mean, is it part of it that the Fed, with stopping your sort of the quantitative easing, is sort of sucking it out of the economy?
That's exactly what they are hoping to do to slow things down. That's what helped perpetuate the 40-year high inflation problem from the beginning. So what was a tailwind for the economy will become a headwind, looking at consumer spending.
Florida, here I come.
So S&P now is at 4160 right here. And in our worst case, bear case scenario, we think it could come down to about 3,500, which is about a 15% correction. If we had to guess where we exit the year, it's going to be pretty close to where we're at. As I said earlier, we think the market will start looking forward into that 2024 earnings estimate assumption, and that will help support the market. And the market will also take comfort in the fact that maybe in December of this year, the Fed cuts by 25 basis points, and maybe they cut by 200 basis points in 2024. So that will certainly put an underpinning in the capital markets. I think that's really it. I'll turn it over to Brian, and he'll review some of the trade's activities for the portfolio last year. He'll review performance and talk about our outlook on asset allocation as well. Any other questions for me before I turn it over to Brian? Thank you very much.
So let me just provide a little bit more sort of historical context around the returns that we experienced in 2022, and then I'll get into the portfolio. And in the spirit of turning the page on 2022, I'll give you an update on January of this year. But here we're showing the returns of the major capital markets during the fourth quarter in the first column, year to date. So for the full year, calendar year 2022, in this second column there. Fourth quarter was actually pretty good. We had pretty strong returns on the equity side in October and November, gave a little bit back in December, but in whole, fourth quarter, U.S. stocks were up about 7.5%. markets outside the U.S. were up double digits. So for as bad as 2022 was, and you look to the next column, we actually were a lot worse, as Jim talked about earlier on in the year. And again, to provide a little bit of historical context, the S&P 500's return of down 18% in 2022 was the 7th worst calendar year return since 1926. If you go down to the bond market, and Jim touched on this too, sort of the dual bear markets we experienced in stocks and bonds, the bond market was down 13%. The 100-year flood in the bond market before 2022 was 1994. The return of the bond market in 1994 was down about 3%. We were down 4 times that in 2022. So dual bear markets, nowhere to hide. Everything was down as a result of the higher inflation that Jim talked about and the rising interest rates that we experienced last year. Okay. I promise I'll get to some good stuff in a bit. Again, last year was a challenging year, but we were very active in the portfolio. Here's a list of all the things we've done, swapping out of managers, doing various trades. I would say if I were to characterize the things we've done, I would use kind of 2 overriding features of what all this stuff represents. Number one is we, believe it or not, de-risked the portfolio. So what does that mean? It means we sold stocks and we bought bonds. Unfortunately, bonds were down in many cases as much as stocks were, so it didn't really help. We got rid of some underperforming managers. We increased our use of index funds. That's a form of de-risking as well. But the whole point of all this stuff was really to set the portfolio up for this year in the eventual recovery. And so we didn't sit idly by letting markets thrash us about. We did take a lot of actions. We're set up well, and when I show you January's results, you'll see the impact of all these trades. We go here. So here's the results. Again, I mentioned fourth quarter is actually pretty good. We were up 7%, roughly, a little bit higher than 7%. We're slightly behind the benchmark in the fourth quarter. But that's because we went into the fourth quarter, and I talked about in the various trades, we were underweight stocks, and stocks had a really strong fourth quarter. So that's what's driving that underperformance there. You can see year to date we're down a little over 17.5%, below the benchmark. And the reason we underperformed last year, I know it's hard looking at these big negative returns. Trust me when I say this, there's nobody that's happier than Jim and I that we're turning the page on 2022, but nonetheless, this is, I think it's important to, obviously, to review what happened and sort of, as much as we can, learn from it. But a lot of what's driving the underperformance there are the active managers we had in place. If there's one thing that was really disappointing to us in 2022, is that active managers did not live up to their end of the bargain. And what is their end of the bargain? Usually when markets are down, they outperform. Didn't happen this time. Didn't happen in 2022. And that was the really disappointing part. Now, I talked about a lot of the trades we've done earlier as sort of setting ourselves up for the eventual recovery in markets. And we think on the equity side, we'll see a little bit of choppiness here, probably in the first half of the year, but things, as Jim talked about, look better in the second half of the year. When markets go up, active managers tend to underperform. It's a big reason why we've increased our use of passive management to set ourselves up for that eventual recovery in the equity markets. Again, I'll show you January and give you a little bit of context, the early part of February as well. So since inception, going back to when we started working with the city back in 2016, we're up about 6.5% or so, right in line with the benchmark. The one thing I think that's important to point out here, and I'll just call on the investment earnings line here, which is the third row down, all the way on the right-hand side. So about 6.5% a year for, what is that, 6 years or so? Translates into almost $70 million in the plan because of the investment earnings that have been generated. I know there's a lot of discussion around returns and funding status and all those things, and we talk to the council once a year about that. But these are real dollars, right? The board is challenging of an environment it was last year. The board's made really good decisions in our view, and that's contributed to the nearly $70 million over the span of 6 years. In terms of our exposures, again, this is the end of December. We're slightly underweight equities because we, coming into this year, we're a bit cautious on equities. Now, that positioning hurt us, quite frankly, in January because equity markets were so strong. I'll show you that in a second. But even though we were underweight equities, we still outperformed by a considerable amount, and I'll get to that in a minute. Let's skip ahead a number of slides in the interest of time. And I'm gonna go here. These next several slides, and I apologize, you don't have hard copies in front of you, are all of the managers we have in the portfolio. I talked about the one disappointing part about 2022 was active management didn't live up to its end of the bargain. If you looked at all the active managers we have in the portfolio, we have about 10 of them. 6 of them underperformed in 2022. We would have expected that percentage to be a lot lower. Again, based on historical value that active managers typically provide in down markets that just didn't materialize in 2022. We actually had pretty good results from active management in the fourth quarter, where 6 out of our 10 outperformed in the fourth quarter. So we started to see some of that relative positioning from an active passive mix perspective starting to work in the fourth quarter, and it's worked even better into the early part of 2023. So despite how bad 2022 was, we actually feel very good about the exposures we have in the portfolio, about how we're positioned, and how we expect the capital markets to unfold here in 23. The last thing I want to point out is here. So we have about 9 or 10% of the portfolio in what's typically referred to as alternative investments. Now that's a catch-all phrase. It means really anything that's not publicly traded stocks and bonds. So in our portfolio, we've got a bunch of real estate. We've got a couple of hedge funds. This portfolio in aggregate in 2023 was up 9%. I'm sorry, in 2022 was up 9%. So it's working. It did its job. We just wish, the rest of the 90% of the portfolio and the active management in particular would have held up its bargain, but those exposures worked really well in 2022, and this is why we have that exposure. It's to protect on the downside, and it's, again, our portfolio was down 18, this was a positive 9, so significant returns in light of what went on in the capital markets in 2022. Yes, sir.
Do you have an opinion as to what our portfolio would look like if it was 100% passive investors?
Yep.
Investments, because as you said before, the active managers did not live up as you would expect in a down market.
Yep.
And I was just curious to, especially in consideration of the lack of fees or the reduction in fees as a result of that.
Yep. In 2022, if we were 100% passive and we were exactly on the weights in our investment policy statements to stocks and bonds, our return would have been minus 15.65%.
Yeah, the blue bar.
That's right. The
Gold.
the yellow bar. Yeah.
Yellow bar. Oh, okay, orangey yellow,
Yeah.
yeah.
The blue one is our actual return.
Okay.
The yellow, gold one, orange, or whatever color that is 100% passive.
So, and in the year before that,
Yeah.
would have been, well, what would have been the difference between the active and the passive the year before? 'Cause obviously we lost less money in 2022. If we would have lost less money in 2022 if we were completely passive.
I don't recall what 2021 was, but I suspect we did better than the benchmark. So the active management added value in that year. This number. So if we go back since inception, right? So our return is 640, the benchmark's return is 652, so we did a little bit worse. But it's all because of what happened here. So up until 2022, active management was extraordinarily successful for us. And a lot of that success got wiped out in a single year.
Right, because I kind of remember that where it was really good. We were coming out of 20.
Yep.
And then 21, we were like, yay, but we better expect, ooh.
I think I think it was in the if I had to guess, and we can certainly look at this, but active management started to disappoint in the second half of 21, and then the full year in 22.
Because y'all cut some out.
Oh, we did.
Yeah,
We did.
I remember
So,
that conversation.
We had about 80% active management. I would say this time last year, we're down to almost 60, and that'll continue to drift down a little bit more. Our goal would be to get close to evenly balanced between those two.
I mean, I think it's still good because we could have got hit worse. And in comparison from when we started with you all to now, I mean, you can really see it's not that big of a difference. And I can't imagine if we had done this in-house, what that would have really looked like.
Look, we're disappointed, and we're not going to sugarcoat that in 2022. And again, we talked about what the most disappointing aspect of things are. If you looked at the really long-term return, and we recognize that a lot of the managers we have in place, we don't have that really long-term history with the city, but they all invest in, sorry, I'm back to this slide. Over a long period of time, it's this that did so poorly in 2022 that drives long-term returns. In fact, you just kind of go over this quality issue. Now, what the heck does quality mean? Well, it means companies that have low levels of debt on the balance sheet. It's companies that have really strong products in the marketplace that can pass price hikes through to their customers, that have good management. It sounds strange to say, well, why on earth would anybody invest in any other kind of company other than quality? But it does happen. It just happened that this feature was one of the worst returning segments of the market in 2022, and that's what we've got a lot of. But if you look over time, and we're just going back 5 years here, it's one of the best returning features of companies in the market. In fact, if we went back further 10, 15, and 20 years, you'd see it's probably the number one factor that's driving capital market returns. This is what we want to avail ourselves to, and this is why we have active management in the portfolio and certain kinds of active management. You just get short, discrete periods of time where it just doesn't work, and that was what happened last year.
I'd just like to make a couple comments. So the most important decision is sort of the strategic allocation and how you bucket to the major asset classes, how much of percent of the portfolio is in stocks, bonds, and other. And we changed that, and I think it was 2018, to a what I would say a much more sort of conventional allocation for a municipal pension plan And that decision, we don't have the data on that, but I pretty confident that if our current allocation strategy that we're on has vastly outperformed the old sort of strategic allocation.
Yep.
And then beyond that, so you have that strategic allocation, and Brian and Jim are trying to beat that strategic allocation as if it were invested passively, and that's the the benchmark. And they basically beat that in two ways. They either alter how much percent they have in stocks or bonds to beat that benchmark, or they use active management and hopefully they pick the best stocks. And over the 5-year period, I think it was 6.4 the portfolio was returned, and the benchmark was 6.5, so they are slightly behind the benchmark, but they're showing it net of fees. So over that 5-year period, they're at least paying for some of their fees through the sort of active management. And also, the benchmark shown as the benchmark's not free. Even passive management costs something. So if you could add fees to the benchmark, whatever it is, 10 or 15 basis points, and it's in my eyes, it's basically break even over that period. Does that make sense?
Yeah, to me.
We have every expectation that our net of fee return will be higher than the benchmark's gross of fee return. If we can't add value for what you pay us, well then it begs the question, why bother, right? And again, if we, and I know we can't do this, but if we cut the clock as of 12/31/21, you'd see a very different result. It was significantly higher than the benchmark. We'll get back there, right? I do want to, I said, I promise I'll talk about some good stuff. So I want to sort of give a January update here, and here's where we're at. So, we ended last year at about $182.5 million in the fund. We added through investment returns, not contributions, but investment returns, at about $9 million in the month of January. January.
Okay.
Has that been in large cap growth?
It's been across the board. So the S&P in January was up about 6.5%. Small cap stocks were up 10. Non-US stocks were up about 8, both developed and emerging markets, plus or minus. And the bond market, believe it or not, was positive 3%. So everything was up in January, just like the flip of what 2022 was. I'm going to talk about the various bets we have in the portfolio and the impact it's had in a second. Our target to US stocks, talked about the alternatives piece, about 9%. Our allocation to stocks is 67%, about 2/3 of the portfolio. Our target is 70%. Okay, so we're slightly underweight. We were a little bit more underweight at the end of December, but equity markets outperformed in January, so that gap closed a little bit. But as Jim talked about, our outlook is for the first half of the year stocks to be a little bit choppy, and bonds to generate pretty decent results. This is just the public markets return piece of our portfolio, along with a benchmark that just represents public markets for the month of January. We don't have any values on the alternatives piece. That takes time for those to come through. We're up 7%. Our benchmark is up 6.2%. So 80 basis points of excess return in a month, I will tell you, is pretty good. And again, Landon, to your point, our return is net of all fees. So we've got about a half a dozen bets, for lack of a better term, in the portfolio. Some of them helped, most of them helped, a couple of them hurt in January. Talked about the fact we're underweight stocks. At the end of the year, we were about 4 percentage points underweight stocks. Well, that hurt us in January because stocks were up a lot better than bonds, 7% versus 3%. So if we were right on target, we would have done even better than that. But even
in light of that underweight, still strong return relative to the benchmark. We're overweight to small cap stocks. If you looked in the US equity markets, about 11%, let's just call it 10%, I like round numbers, 10% of the market is small cap stocks. We've got about a 2x weight there. That's a big bet for us. That worked really well in January. Small cap stocks were up 10. Large cap stocks were up 6. We're a little bit overweight to non-US markets, the developed world, so Europe, Japan. That helped in January. Non-US markets, as I mentioned, were up 8 versus 7 for US stocks. We're overweight emerging markets within non-US markets. That was pretty neutral because both emerging markets and developed non-US returned about the same during January. Bond duration. So we have shorter maturity bonds in our portfolio than our benchmark does. We're about 0.8 of a year short.
I saw that you sold one of your trades, you extended the duration.
So there's a couple of things going on here. So during the course of the year, we were very short duration early on in the year. Then we extended duration. We extended duration a little bit too soon, for sure. But we extended duration. We were still short at the benchmark, though. We just lengthened duration. The other thing that's going on here, which is bringing this number down in terms of being short relative to the benchmark, the last trades we sold when we reduced our equity exposure, we just bought short-term bonds. So that, because short-term bonds are yielding more than long-term bonds, and so the impact of that was to make this number even shorter than it really is. The interesting thing in January is if you looked at our overall bond portfolio, even though we're short duration and shorter duration bonds do worse when interest rates go down like we experienced in January, our bond return in aggregate outperformed the benchmark. So even though we had that shorter duration, it hurt us in some sense, but it really didn't hurt us because we still outperformed. Active management, 7 of 10 outperformed, 1 matched. That's a old number. We're closer to 30, about a third passive, so 2/3 active. Here are the active managers. You can see a lot of them, some of them did exceptionally well. Value guys outperforming. Our small value guy behind benchmark. Last year they actually outperformed our small value manager, but underperformed a little bit. Our small growth guy outperformed. Our non-US equity managers outperformed. Our emerging market managers outperformed. And our bond managers, as I talked about, did pretty well.
That artisan is crazy.
A lot of vol there. And that's one that we've systematically reduced over time, and good thing we did, and kudos to the board for that decision. Jim and I were just talking about this. Early on, and I would say 2016, 2017, we had a very significant exposure to emerging markets and to artisan in particular. They did exceptionally well for us, and over time we've reduced that exposure. So yes, we still had them. They underperformed dramatically last year. They're off to a good start this year, but the impact it's had on the overall fund has diminished significantly. February is sort of starting to be a little bit of a mixed bag. U.S. stocks are still up through yesterday, and I saw the open this morning, we're up again. U.S. stock market's up 1% in the first week of February. Non-U.S. markets are flat to down slightly. Bond markets down a little bit, certainly not getting back anywhere near the gains that we experienced in January. Any other questions?
I'll just add to Brian's comments about January's performance. So the weight of the rising interest rates on active managers really hurt and very disappointing to us, especially given how hard we worked to generate excess return prior to last year. So we think we'll get back on track. And our expectation is that if the markets are down 20%, that these active managers have a chance to purchase the best companies in their space. And so when the economy does start to normalize and that tiny campaign ends, we should expect that alpha, that outperformance that we delivered in the past using active managers. It really is certainly our expectation.
Yeah. Yep.
So, your outlook for 23 is good?
Better than 22.
Okay.
We think,
Focus on 2024.
yeah, we think the U.S. equity market in 2023 is going to, if you looked at end of year last year to end of year this year, it's probably going to be pretty flat.
Okay.
But the pattern, the pattern of getting to that flat return is in all likelihood going to be down in the first half of the year and then up in the second half of the year. So we continue to be underweight stocks. We want our, as the earnings decline that Jim talked about, and in fact, we're in the midst of earnings season right now. I think about 70% of companies reported. Earnings are down about 7%. The stock market doesn't care. Because the stock market is seeing, wow, 1 month down the road, 2 months down the road, the Fed is going to stop hiking rates. But those earnings are still going to be pretty weak. So the market will care at some point. And that's going to drag the market down. Once that happens, we're going to be buyers rebuilding our equity position on the way down. Depending on how far it goes, we may even go a little bit overweight stocks. We'll just have to see how it plays out. The other thing I will say is, what happens if we're wrong? I mean, look, January was up a ton and we were underweight stocks. Now we still outperformed, which is great. We could have done better. So what happens if the market continues to grind higher? We're not going to stay on the sidelines forever. There will be sort of a time element as well to sort of rebuilding our equity position. We don't think we're there yet. We want to see how this thing plays out. We expect there to be some volatility in the next couple of months, so we think we'll be able to buy at shorter or lower levels. But we're not going to wait forever either.
Equity investing, you have to expect ups and downs.
You do. It's part of the drill.
And I just want to remind everyone of that. With my personal money, I do not do that. But this is a retirement system, and we've got to prepare for the long term. So.
The worst thing anybody can do, and this is true for a pension system, it's true for an endowment fund, it's true for all of us individually, the worst thing we can do is to sell out when the markets are weak. That is incredibly capital destructive. It is virtually impossible to recover from those decisions. We're not doing that. We'll over and underweight stuff at the margin here. You see we're 3 or 4 percentage points different than the benchmark. We're not taking big bets saying, boy, we think earnings are going to be weak, let's go from 70% stocks to 20. You'll never see us do that. And it's because we've got time on our side. Even though it's a closed system, there's still a very long tail where equity markets and the positive returns that have historically come from equities will work in our favor.
I hope the policy wouldn't allow that.
It wouldn't. It doesn't. I think we can go plus or minus 10 percentage points. Yeah. Again, even if the policy allowed it, we would never do that. So.
Well, it's good discussion to remind us where we're at.
Yep.
Kind of what we're in.
So, Brian, you're going to decrease our exposure in artisan further, but not overall in the emerging market realm? I wasn't quite following that.
We're comfortable where artisans' allocation is today.
Good.
So my comments earlier were back in 2016, 2017, and 2018, we had a much larger allocation to artisan. And that worked really well in our favor. And over time, we've been reducing that allocation. We cut it back before the returns got bad. So we locked in a lot of those good, strong gains. But we wanted to diversify away from them a little bit, which is why we cut back on their allocation. We didn't reduce the allocation to emerging markets more broadly. We just got more diversification within emerging markets. So we feel good where we're at now. We've got 2 active managers. We got a little bit of passive there. And we feel good about the way that, the composition of that portfolio.
So, just for those people who are listening, I want to remind the fund has, at least at the end of January, had 191 million, and the city continues to make its contributions, and that there is enough money to make pension payments,
Yep.
even if the city didn't make any more contributions, enough to make pension payments for many, many years, but the city will continue to make its contributions, and we will continue to manage this fund.
And I think you made one last week?
Yeah.
Yeah.
Within, a few days
I'll
ago.
mention that.
Yeah.
Yep, 7.8 million.
Yep. And it's a during the budget process, that is one of the first things that is plugged into the budget,
Yep.
is the OPEB and the retirement. So it's never off the radar.
Well, not to get off on a tangent here, but this is something that the city and the taxpayers should feel good about, because I can't tell you prioritize the pension contribution. I can't tell you how many states and municipalities use that contribution as a lever to balance their budget.
Yeah.
And that's why the state of public retirement systems across the country are in the shape that they're in.
All right. Thank you. Tom, were you able to cover everything that you needed to?
Yes, yeah, thank you.
Okay.
I'm going to resend out the agenda package just so you have it. And I'll make sure the right versions are in there, and
I apologize for that.
don't worry about it. I will ask, I'd like your feedback on whether we need to make copies. I think having, handouts on at least some of the key issues for the portfolio is important, but whether, we burn a lot of trees when we make these big package copies, so, how does this work out for you today? And especially if I send you additional information electronically, so you have it in your email box and you have it in your files. So.
Electronic works for me.
Yeah. Me too.
Yeah, it's less to keep up with. All right.
Okay. Meeting adjourned.
Thank you.
Thank you.